Estate. We are here with Neal Bawa. Neal is known as the mad scientist of multifamily. He's grown a $600 million plus real estate portfolio by applying data science, AI, and innovative syndication strategies. He's the CEO of Grow Capital's Mission 10K and Multifamily U, using institutional level systems to help investors scale through measurable, process driven decision making. Without further ado, welcome to the show, Neal.
Thanks for having me on the show. Very excited to be on.
Yeah, we're thrilled to be able to have you on also, Neal, and chat with you a little bit more in regards to just commercial real estate. And you're remarkable. I mean, some of the things that you teach, I know that I was sharing with you offline that a lot of the things that you give away for free within some of these coaching programs and these masterminds, guys are charging anywhere from 5 to 10 to 20 grand for the information that you're giving away for free. And so it's outstanding to be able to chat with you online here and also introduce you to my audience. And but it's before we get too far into the show, if you could share just a little bit more about yourself and also how you got started in real estate, that'd be great.
Yeah, before I give you an introduction to myself, I want to sort of address what you mentioned, Eric. Uh, yes, I believe in the Wikipedia way of living, right? Nobody makes money off of Wikipedia. I believe that there should be a Wikipedia of real estate information. And so, many years ago, more than a decade ago, we started building one. And now we have a ton of people, tens of thousands of people that essentially follow us for that. And they like the fact that there is no subscription, there's no upsell, there's no silver tier, gold tier, there's no way to basically, there's no monetization at all. Like not $1 is monetized. Of course, we have syndication projects and some of those people become investors, but otherwise I think information should be free. And so that's why the club that we built is designed for information to be free. Very often, Eric, like many times, people will come up to me and say, why are you giving this stuff away? People are charging 10 grand a year, 20 grand a year for it. And my answer is that we live in the information age. In the information age, information should be free. And, people should be charging for skills, for coaching, for all other services. I'm not bashing anybody's service, but I think information, high quality information, should be available for free because that's the world that we live in. So, hopefully you understand why I'm not charging for this.
Yeah, no, I understand 100%. And so you're basically the Google for real estate between you and Bigger Pockets. And there's a couple other guys that give out some really amazing information. But yeah, 100%. I love exactly what you're doing. But yeah, if you could just elaborate a little bit more
Sure,
on who you are and how you got started in real estate as well.
sure. Technologist or recovering technologist, computer science degree. Data science is a passion of mine. I call myself an amateur data scientist, somebody that learns all the time, and hopefully one day I'll get to a professional level, maybe million years in the future. But you know, my goal is to use data as well as I can. And it's not to say that other people don't use data well. I just like to go a few levels deeper than other people and really understand where the data is going, where it's pointing to. I know that there's lots of people that think that they're data driven, but it's about the level to which you're data driven. So I've had a successful tech career. I've run a tech company for 14 years, tech and healthcare. And while I was doing that, I was living in California, earning the big fat tech salary. And so I was paying 50% of my income, almost 50% to the man. And I got into real estate in reverse, basically to save taxes, through the magic of depreciation and other benefits, and then sort of got addicted to it. And in 2009, I opened a meetup group about the data science of real estate, and it sort of became a hit because I live in Silicon Valley, and there's lots of geeks and nerds here, and so the whole thing sort of exploded, and we kept improving it over the following 4 years. And then in 2013, when I had my big taxable event, the company was sold. It just made sense to sort of move into real estate. Now we have about 1,300 investors. All of them are accredited, and their money is invested into a portfolio. Values go up and down. Right now they're down 400 to, right now probably around $600 million in portfolio value, but goes up and down.
Wow. Yeah, that's amazing. And so you're still in California, Silicon Valley, and that's great that you were able to see that real estate was a great vehicle. What made you gravitate more towards real estate rather than going into a second business? Because it were you working for a person, or did you sell a company, if I heard that correctly?
I was a minority owner, minority partner in a company, and it was a healthcare and technology company, and we provided training. And so we had, these big campuses. And in 2003, I got a chance to jointly work with the very, very bright owner of the business to develop a campus pretty much from scratch. So it was 27,000 square feet, developed from scratch. Huge project. We made lots of mistakes, no investors, no loans, just us. The business paid for it. And when I did that, I realized that there were huge benefits to depreciation, right? Massive, massive, massive reduction in your taxable income. And that sort of got me addicted. We ended up building more campuses in the future, ended up getting taxable benefits from there as well. And then by 2009, I had a lot of money in the bank thanks to the fact that I was paying less in taxes and my timing was right. And so when I was looking around, my sort of amateur data science interest was showing me that I was um, that it was the greatest time in 100 years to buy. But I would go to a
Mhm.
party and I would naively tell people that, and everyone would immediately call me an idiot. Some people called me an absolute moron. My family actually stopped me from going to family events because they thought I would infect the other kids in the family with my stupid thoughts around real estate. And so I was like, but the data is saying this is the best time ever, right? And so I was like interested in finding other like-minded people like me. Maybe there's other people out there that believe what I believe, and that's why I started that meetup group. Meetup.com had sort of launched as a company, and we were working with them. I had large classrooms inside of my business. So unlike other people that fight, traffic to go to a meetup, I was basically fighting 150 feet of traffic from my corner office to my conference room and doing real estate meetups in there. So it sort of made sense, because I don't know of any other area that has the spectacular level of depreciation and other benefits that you get from real estate. So it made sense. And once I got involved in it and created the meetup group and built an ecosystem, we just never looked back. Even though for the next 4 or 5 years after we started it, there was no business. It was just a meetup group with a bunch of people meeting and discussing, their amateur interest in the data science of real estate.
Wow. Yeah, that's a great start. And so that started in 2009, correct?
Nine, yeah.
Okay, sweet. Yeah, so that that was an amazing time to get into the business. And so just as your data science was 100% correct, telling you that it was a great time to be able to get into the business, it actually checked out because 2010, 2011, the market recovered and it just took off and began to soar. Where would you rank that run amongst all the, well, not all of the real estate cycles, but where would you rank that? I'm just curious because it was historic, or it was just in a great market from 2010 up to about 2022 at the beginning of the year. Where would you rank that in maybe the last 100 years?
So I think that is the single greatest run that you would ever have. I just want to point out, Eric, I don't consider that to be one run. So I consider 2009 to 13 to be one run. And then it sort of averaged out after that. 14, 15, 16 were okay. And then it really started to run again in 16, 17 from a multifamily cap rate perspective. We saw more and more cap rate compression in 15, 16, 17. And then, of course, what happened, after COVID was crazy, right? So I think the greatest run of all time is actually, I'd say all of 2021, all the way to maybe first quarter of 2022. So that 15-month run, the kind of cap rate compression that we saw, the kind of per unit prices that we saw then, I've never seen. So I'd say that 15-month time frame is the greatest real estate commercial run of all time. I would say that 2009 to 2013 is the greatest single family home run of all time, because that was really very, single family wasn't at all impacted, or prices didn't go down in 2021. I don't remember that. But 2009, of course, in many parts of the US, you could get a single family home brand new for $90,000. I myself purchased a dozen Kaufman and Broad 4-bedroom brand new homes, and many of them no one had ever lived in, right? No one had ever lived in them. They've all been built between 2005 and 2008. And I was able to basically get these homes for $90,000 when even in 2009 the cost to build them was probably around 230, 240, right? So that, from a single family run, incredible, absolutely mad run. And then from a commercial perspective, apartment perspective, I think 2021 can't be beat.
Okay, yeah, that's great. That's great science there. So, if we could, let's I want to provide value to my listeners. And so you mentioned that you were operating a healthcare business and you were a minority owner within that business, but you were building a portfolio while you were doing that. And so, if you could just allow us to peek inside of that. What did you do? How were you able to successfully compartmentalize both and be successful at both? What was the method that you were using? Were you up late? Were you sleeping 2 hours a day? What was the strategy for you?
Well, my family is in the Burger King business, and they own, more than 100 Burger Kings. And my uncle, one of the things that he always says, and I worked at Burger King for one day on Thanksgiving Day 1997, and decided I'm never going to make a burger again in my life. But I learned something from him. He said, Neil, I am not in the Burger King business. I'm not in the food business. I am in the real estate business. And I
Mhm.
use the food to increase the value of my real estate so I can make more real estate, right?
Mm,
So he would build or buy real estate, buy Burger Kings, underperforming Burger Kings. He would basically make them better, and then he would sell the land, under it to somebody as a coupon. Somebody who wanted a coupon and wanted a Burger King tenant, right? And so now he had recovered all of the money that he had put into the purchase of the Burger King by just selling the land out from under it, and still having a Burger King, right? So I think I learned a lot from that, and I realized that any business, most businesses that are running well, can benefit from owning real estate. Now, if you can build real estate, which most people don't do, then you can doubly benefit because now you haven't paid a lot for that, and you can custom build it for your own business. So the first campus that we built, um, we were General Motors tenants, and GM didn't like the fact that we had a lot of students that would basically track mud all over their carpet during the rainy season. And so they basically told us, hey, you've got a year left on your lease. We're not going to renew. And we were like, okay, well, we've got a year. They've given us plenty of notice, so that's nice. What can we do in a year? So we started looking at shells. A shell is basically a office and flex building where you have windows and you have this, door, a box, but there's nothing inside the box. It's completely empty, right?
mhm.
So all the advantage that you have is you have a parking lot and you have a box with windows, and now the rest of it has to be built. So we bought a shell building in Fremont, California, and we basically subdivided it into 27,000 square feet with offices, sales, cubicles, classrooms, administrative, executive, stuff, break rooms, things like that. So we basically custom designed it for our business, and it was incredibly, incredibly successful because very, very few people in our business had ever built a custom campus for our exact needs. So it was very efficient. It was designed to be exactly right sized. Um, and we made a tremendous amount of money because of it. And then once we learned, we said, let's do it again. So we did it many times more.
Okay, sweet. And so when you were operating this healthcare business,
Healthcare and technology, both.
healthcare and technology, what was working for you to be able to do these designs? So what was the first real estate transactions? Was it the single family houses that were new builds, or what was the first purchases for you when you first got into real estate?
The first one was the 2003 shell building that we built into a
Oh,
campus for our business. That was 2003. I didn't buy a single family property until 2008 when the crash happened, right? So 2007, there was panic. 2008 is when the prices started to crash. I think at the end of 2008 is when I bought my first single family. And then I just continued to buy one a month all through 2009, all through 2010. And then, like an idiot, I stopped. Should have just kept going for another 3 or 4 years, but the prices were going up or beginning to go up now. There weren't as many easy deals, and I was afraid that I was buying or overpaying, as it turns out. I mean, even if I'd paid 25% more than I'd paid, that I was thinking of paying, that would have still been an incredible deal. So 2008, 9, 10, 11 is when I did tons and tons of single family. And, 2013, 2014 is when I bought my first multifamily. And my the switch from single family to multifamily had to do with the fact that, my company got sold at a huge multi-million dollar tax event, and single families were just not going to cut it, right? So it made sense to buy a big multifamily.
Got it. Okay. Sweet. Okay. Well, hey, we definitely appreciate you kind of going back and just sharing exactly where you were when you were building your first company and then venturing into multifamily. And so, if we could, let's bring things up to more current events. And so now you're up to $600 million in real estate. Kind of chat with us about that. How did you get there? And so we know that you started a meetup, you transitioned over to commercial real estate. What was the process like for you to build to the level that you're at right now? Was it systems? Was it processes? What was the secret to the success?
I think it had to do with the fact that I was very interested in giving away information relating to my amateur data science activities. So the meetup grew because I was in the right place. I mean, Silicon Valley, lots of mathematicians, lots of technologists. They liked the fact that we were basically, you know, looking at the data science of real estate. Now it's sort of morphed because what people were most interested in was ranking cities, right? So we did lots of different things, but the city ranking thing became a key thing. And so what we did was we turned it into a free course. It's given away for free. Tens of thousands of people have taken it. It's called Location Magic, and you can find it on multifamilyu.com/club. So it's a free course. It's very popular, and I even put it on a website called Udemy, and you can actually see currently there's 15,000 people taking the course on Udemy with over 1,000 five-star reviews. The newer version of the course is at multifamilyu.com/club, so you should go there. Bottom line is that we were basically trying to demystify how to rank cities, right? For real estate, like which city can make more money for single family and multifamily, and how to sort of gauge if this is a good city to invest in or a bad city to invest in. I'd had some bad experiences in South Chicago with properties that I'd overpaid for. So I tried to basically take that pain and develop it into something positive. Um, and so that's why I created that Location Magic course, and we were teaching it as a meetup. And so over time, what happened is that our brand grew, right? There's like, people are like, there's this bunch of nerds, these geeks that are mostly like tech guys. They're not real estate people. They don't talk real estate lingo. They don't have any broker licenses, but they have this meetup, and they don't allow any pitching. And they're just offering tools for analysis and things like that. We'd done lots of things, right? But the whole city thing took off, and we became known for being able to rank cities. Like right now, for example, Eric, if you're basically at work and you're having a water cooler conversation, somebody starts saying Indianapolis is a great market to invest in, and you're like, no, 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 Indy is not so good. It's Oklahoma City, right?
Mm-hmm.
And
Mm-hmm.
and it's possible that they're both great markets to invest in. It's also possible that they're both shit markets to invest in, but people don't really know. So how do you compare Indianapolis to Oklahoma City, right? What is an easy, simple way to compare? We were trying to create a toolkit for that, right? It's not by any means comprehensive. I mean, there's probably 50 ways of doing this, but we were trying to create a way that was free, was based on public data, and you could compare any two cities in less than 10 minutes, right? So using various methodologies. So that became sort of a mantra for us, and we became known for it. And I started getting calls from conference organizers saying, "Hey, you're that nerdy guy that ranks cities. Why don't you come and teach at my conference?" And I'm like, "I'm not a real estate guy. I'm running a tech company. I don't have any investors. I'm just one guy, right?" And they're like, "Yeah, yeah, we like that. We you're like you'll be the token nerd that doesn't have a pitch at our conference, right?" So I started
Mm-hmm.
getting invitations. First, I got conferences for free. Then they started sending me hotel and airfare, and I was like, "This is very cool, right?" Now I
There
know,
you
of course,
go.
I should have charged for my time, but I didn't know back then that I should have
Uh-huh.
charged. So I'd go and present Location Magic and other interesting things about real estate at conferences, and started to get known. So a database got built. So when it was time for me to start to transition into multifamily on a full-time basis and start buying buildings and building buildings, I've built projects that are 300 units over $100 million for one building. I had a natural group of people, and these natural group of people were also sort of geeky, nerdy like me. And they were like, yeah, we like this guy's approach. Maybe he'll do the right thing. Maybe his projects will work. Maybe they won't. But at least he seems to be using a methodology. And I like that methodology. Once again, I've never said that data science is magic. You can still make lots and lots of mistakes. Um, I'm sure there are people out there that use their gut feel that are more successful than I am, and good luck to them. But I do think that if you follow the data, you may improve or are likely to significantly improve your chances of success. That's all there is to it. Like there's no magic, right? And don't think that there's magic. So I think what I've always tried to do is to say, how can I get in early and get out, before everyone else? Because I've suffered, I've had projects where I haven't done that and I haven't been successful. And so I'm constantly trying to learn and to basically predict and go into cities early, right? What makes cities tick? What makes a certain city better than others? So if you look at Location Magic, which is on multifamilyu.com/club, you will very easily see that there's 5 things that we rank. And I internally, on a professional level, I have 12 things that I rank, but these 5 are still the most important ones, right? So it's population growth, income growth, job growth, home price growth, and crime reduction. So these 5, we provide people a toolkit that says, name a city, random city, Cincinnati. Here, in the next 5 minutes, you're going to gather 5 pieces of data on Cincinnati. Then name another city randomly, Provo, Utah. In the next 5 minutes, you're going to gather the same 5 pieces of information for Provo. And you're going to plug them into an Excel spreadsheet, and it's going to give you a very true look at these cities and how successful you're going to be for real estate. Not magical.
Mm-hmm.
If you buy a bad property, you'll still fail. But if you bought the same property in Provo versus Cincinnati, I think the toolkit would help you have a significantly better outcome.
Yeah. So it sounds like you guys just gave away free information. It was extremely valuable, and you guys exploded from there. So,
Yeah, I know that there's coaches now basically using my system, and they've renamed it, and they've used it with their students. And so there's students that have come in and said, why don't you sue this guy? And I'm like, why would I sue him? My goal was to spread this. He is
yeah,
spreading this.
yeah.
I'm going to thank him, not sue him.
Yeah, that's great. Yeah, and it's extremely helpful. So I've taken the course on Udemy, and I've peeked in on you with multifamily U as well. And I mean, it's just extremely valuable information. I'm a newer syndicator, and so I look up to guys like you that's been around for some time and extremely successful. And you use data and science to be able to come up with solid investments. I mean, because at the end of the day, everyone wants to be successful with the properties that they close on instead of having a failed investment and harm investors' capital. So yeah, yeah, definitely great job on that.
Well, I want to point out something. This is very important, Eric. Not
Hmm.
all of my projects are successful, right? Many, in the last 4 or 5 years, I'd say like in the last 4 years, we've had a lot of pain in the multifamily industry. So I have
Hmm.
projects that when they sell, they might lose some investor capital. I think that it's very important to understand that multifamily is not magical in nature. It is an asset class. Yes, it is one of the most preferred asset classes because, shelter is so critical to humans. But I think that market cycles still matter, right? And I don't know any way that data science will overcome market cycles, right? So that is very important. I think people should understand it's still a risky market. We've still got challenges with high interest rates. And so I just want to clarify that there's nothing magical about data science. We're all basically trying to be better at our job, and that's what I'm trying to do.
Yeah. And that's outstanding that you led out with transparency like that, because there's a lot of guys that's feeling significant pain. And so I've been in syndications for about like 4 years. We've got 146 units under management. It's probably right at about 4.6 million in asset value. So just a drop of the bucket compared to what you guys are doing. But there's some guys that are feeling some extreme pain, and they aren't so forthcoming about some of the issues that they're having. And
I don't know what they're afraid of. I mean, the truth is that These are external third-party conditions
Hmm.
that nobody in the industry that I know of foresaw. I don't, maybe there's somebody, but as far as I know, everyone's in the same boat. Um, and it also means that because there's some pain, there's some opportunity. If you're in a market where there's no pain, I can tell you that there's no opportunity. So pain actually leads to opportunity. So I don't know why people are not talking about this more.
Yeah, that's very true. Neil, if we could, let's switch gears here. How are you using AI within your multifamily business? And is there any one and done AI program that helps with underwriting?
So I think artificial intelligence or AI is a way of running your business. It's holistic. So I don't know of any one AI program that's good for underwriting. We've never attempted to create one. What we've attempted to do is to create modules. So we are an AI first company. Everyone in our company has to spend 30 minutes to an hour every day on AI. We have AI training every single week, and every one employee from every department has to show off what they're doing with AI every week in a session that we call Sparkle. Um, we have over 400 built and used AI tools. We call these powered strings, but essentially they are what is known as custom GPTs. So we have a custom GPT for rent comps. We have a custom GPT for parsing through T12s. We have a custom GPT for analyzing a property. We have a custom GPT for analyzing a neighborhood or a zip code. We have a custom GPT that compares, cities. Hundreds of these that we've created, and we continue to create new ones every single week. And I think that's something that people need to understand, that when you're looking for some magical AI tool that does everything, A, they don't exist, and B, even if they exist, that's not AI. What is
Hmm.
AI? AI is a new way of running your business, right? So I'll
Hmm.
give you an example. So, and this is an example from today. So earlier today, I had a conversation with my grant writer. So I pay a grant writer to write grants on some of my new construction projects. And so she told me that at some undisclosed locations in the United States, Walmart is willing to give up some of their locations that they closed. These are supercenters for $1. They're willing to sell them for $1. The catch is you can't just basically take it over and do nothing. You have to do something with it. So she suggested that we convert them into self-storage. Now, I've done self-storage projects before, but I've never converted an existing building to self-storage. So in the middle of that building, at the end of that meeting, we basically immediately called a 5-minute meeting and had a long conversation. So we use AI tools to sort of record transcripts, just like you're recording a transcript right now. And so
Hmm.
we recorded a transcript that basically said to ChatGPT, give us, and we turn on something known as deep research. So it takes a little while for it to do it. It takes 20 minutes for it to do it, right? We said, we want you to give us 5 completed big box store self-storage conversion projects. And we gave it lots and lots of parameters. And we spoke for about 2 minutes. And then we took that transcript and we stuck it into AI, turned on deep research. It asked us a few questions. We let it go. 20 minutes later, it gave us 5 projects. And along with the projects, we asked for names of people. So here's an example. South Bend, Indiana, former Walmart was a true storage conversion. The address is 3701 Portage Road, and it was purchased by True Storage and then transformed into a Class A storage facility. The names of all the people, Chris Lewis, and all the other people that were involved are in this document. So 15 minutes after talking with, or maybe 20 minutes after talking with our grant writer about a new idea, we started reaching out to these people because guess what? I have 2 closed Walmarts where Walmart has offered to let us take it over for $1. But I don't know how to do self storage. I have no
Hmm.
idea how to convert this facility. I'm generally good with construction, but that doesn't mean I know the first thing about this. Could be a horrible idea, right? For all I know, right?
Hmm.
Maybe it doesn't work. So who are the people that it works for? Well, these 5 projects, 4 of them, 4 are Walmart, 1 is Target, right? 5 projects. So I'll just name where they are, just so you know that this is real and this is today. South Bend, Indiana, former Walmart. Belleville, Illinois, former Walmart. Um, Trotwood, former Target, and so on and so forth, right? So Rocky River, Ohio, former Target. So what we did was in 20 minutes, we were able to get intelligence on 5 projects. And then guess what we did immediately? We assigned it to one of our virtual assistants. I have, an army of them. They work in the Philippines for us full time. And on Monday or Tuesday, we will be having phone calls with the people that built these. Because what we're
Hmm.
going to do, we're going to hire them as consultants. We're going to pay $200 an hour and hire these people as consultants because they'll tell us, they'll save us 100 times the money that we're paying them. They'll say things like, don't convert the whole thing, only convert the front portion and do 300 units and then convert it the rest in a different way. Or, well, do you know you need roll up doors, so convert the side part that has the roll up doors. Or they'll say things like, well, we had this problem with the HVAC, make sure that the HVAC is the cooling is like this, because if it's not like this, you're going to pay millions of dollars to convert it. Stuff like that. I don't know that, so I'm using AI to get to human beings that have the competency, the knowledge, the experience, the people that have burned their fingers. I want people that have burned their fingers, and I want to talk to them so that I don't burn my fingers.
Yeah.
This is the way to use AI. Every day we find dozens and dozens of ways to use AI like this. And we love deep research because what we find is AI gives you very frivolous answers often if you don't turn the deep research button on. But the catch, of course, is it's not going to answer you for 20 minutes, right? And 20 minutes to get the 20 pages of incredible information is great. So you've got to give AI that time. And people have become so lazy with AI that they just don't want to click that button.
Yeah. Well, and then that I can only imagine everyone ends up with the same information. Instead of
Yes.
going deeper and entering the prompts and taking AI through the different levels that it needs to go through to get you, somewhat look at AI as it'll get you 50% of the way there, maybe 70% of the way, but then you got
50
to
is a
keep.
long way. If AI can get me 50% of the way to
Hmm.
an important destination, I'm very, very
Yeah.
happy. There, I'll
Hmm.
take 30% because sometimes the 30% is a saving of hundreds of hours, or 30% might be a saving of 10% of my project cost.
Exactly. Exactly. Okay, Neil. Well, we definitely appreciate that. One question before we go into our coaching portion of the show is where do you see the cycle at currently? So, interest rates are starting to somewhat come down. Do you believe that we're at the bottom of the market cycle? And so we're in Q1 of 26. Where do you think that the market cycle is currently?
The market has already bottomed out. So the most key number that you should look at are nationwide cap rates. For those that are listening, when cap rates go up, prices go down. When cap rates go down, prices go up. So for a market to bottom, that's a multifamily, apartment type market, the most important indicator is, are cap rates peaking? Remember, the highest cap rate is the worst point. And then after that, have they started going down, which is, prices going up? And the answer is yes. All throughout 2025, cap rates fell, but they fell very slowly. It wasn't sexy. It wasn't like huge. It wasn't like party time. But it was very consistent that as late 2024, we had rate cuts. And then we, of course, had rate cuts in 2025. As those rates were cut, a quarter, 2 quarters later, we started to see slowly cap rates going down. And so we have not seen the multifamily market get worse in terms of price cuts since late 2024, beginning 2025. So I think the market's already bottomed out. Now, the sad part of it is just because a market is bottomed out doesn't mean it's now going to scream upwards like crazy and there'll be a big party. So we think that the market will slowly rise in 2026. We still have a lot of inventory, a huge amount of supply glut that came, 2025 definitely was worse than 26, but there's still a lot in many markets that's coming in, that's still leasing up, hasn't fully leased up. And so there's quite a bit of desperation there amongst the class A developers, and that means that that's going to keep a lid on rents. So we see, there was this presentation that I was doing for a big conference called Best Ever Conference. It's in Salt Lake, and the presentation was called 3 years of pain, 3 years of gain, right? So
Hmm.
the 3 years of pain were 2023, 24, 25, and the 3 years of gain were 26, 27, and 28. But actually, what I realized is, even though it's 3 years of pain, 3 years of gain is a sexy name, the truth is 3 years of pain, gap year, 3 years of gain. We see 2026 as the gap year. We see that in 2026 you'll see apartment prices slowly going up. You'll see rents slowly going up. But we don't think it gets sexy until 2027. 2027 looks very sexy because there's so little supply. There's so little delivery happening. And whatever got, delivered in 2025 is going to get filled up in 2026. So by the end of 2026, the apartment industry as a whole should be returning to 95, 95 and a half, 96% occupancy. And so that's why we think 27 is when rent growth starts to pick up. And once rent growth picks up, you're going to see cap rates compress because that's what people are they want. They want to be able to show significant rent growth to say, look, buy my building for more money.
Yeah. Yeah, and that was a huge disconnect with the sellers. They wouldn't adjust pricing back in 23, 24, 25, and the interest rates was just so high. A lot of rents were going down or either staying put, and it was a huge challenge. But that's really insightful that you believe that we've already touched the bottom and we are on an upward trajectory. So great information. Hey, we're going to start winding things down. We've got a coaching portion of the show that we like to call our Moonlight coaching portion. If you could hold your response to these questions to between 1 to 2 minutes per question.
Go ahead.
The first question I have for you is, what do you think every new real estate investor should know before investing in real estate syndications?
Well, that's easy. I think you should know it's a risk-based business, right? If you want to take no risk, put your money into money markets. If you want to take a risk, get into real estate. Be realistic, be honest to yourself. You're not buying Bitcoin, but you are taking a risk.
Yeah. Next question is, knowing what you know now, what kind of advice would you give a person attempting to get where you are within their real estate journey about balancing business and life? And so there's the old question, work-life balance. What's your perspective? What's your take?
I think I am a huge fan of work-life balance. I work very hard, but I only work for about 9 hours a day, right? I just compress the amount of time. Often I'm meeting with people in one 30-minute meeting. Sometimes I'll do 5 separate groups, right? So my feedback is don't give up on your work-life balance, right? But and my other feedback is if in real estate, if you're in real estate and you're in the rental business, the big kahuna are interest rates and supply. Remember, you can have the best property in the best market and everything can be right, but interest rates and supply can kill you. So pay a lot of attention to that.
Okay, great. Next question is, if a person had minimal amounts of time, no money or experience, but they want to start and scale a business like yours, what would you recommend for them to do?
Well, given you have very little time, I would suggest that you educate yourself. Education doesn't take a great deal of time. And during that time, you'll understand if you should invest more time into it.
Okay. How about the money part? If you don't have cash, how should a person solve that?
I don't tell people that you should go and pay 20, 30, $50,000 for education. As far as I'm concerned, AI is the greatest teacher, and it's a $20 license. You can learn incredible amounts. Another great teacher is YouTube.
And that's 100% free. Exactly. Okay. Final question I have for you is, what are the best reasons to invest in real estate as a passive investor?
Unquestionably, the best one is tax benefits. Obviously, bonus depreciation is back. Opportunity Zone 2 is better than Opportunity Zone 1. So you've got tax benefits that are absolutely incredible. We used to 10 years ago say cash flow. We don't say that anymore. We don't think that real estate is a cash flow business at this point in time. I think the big reason is no one has figured out what to do about our debt. No one has, and we continue to add more and more debt. Hard assets are considered to be an excellent inflation hedge when your elected representatives in Congress are all falling over each other to figure out who spends more money that we don't have. Given how stupid Congress is, you may want to own some real estate for the day that the world figures out that we're never going to be able to pay our debt back.
Wow. Yeah, that's a great take. You definitely want to take care of yourself because you can't put it in someone else's hands and expect for them to help you to be able to cruise off into the sunset. And so having enough income to survive retirement. And so, yeah, that's definitely a great suggestion. Neal, we want to thank you for coming on to the show. You've been a wealth of knowledge. You shared your early beginnings, how you were able to operate your real estate business on the side of your company and venturing into the multifamily and utilizing AI. Let's say someone's listening to this episode and decide that they want to reach out to you. What would be the best way for them to be able to do so?
multifamilyu.com/clubs. That's multifamily followed by the letter u.com/club. That's where we store all of our webinars. As we mentioned, thousands of people attend these webinars. They're very descriptive, they're very detailed, they're very fun. I think, Eric, you've attended a few of those. Go there, and I can promise you there's no subscription, no upsell, no tiers. Everything's free.
Yeah, 100%. It's amazing. And it's definitely educational content that I'm still taking in and helping me within my business. But Neal, we want to thank you for coming on. We'd love to have you back anytime.
Awesome. Thanks for having me on the show.